Hello and welcome to another video here at Fiscal Voyage. Today this video was recommended by JS. He recommended me to do a video stock analysis on Molson Coors Brewing Company, also known as TAP. So we're going to do a 5-minute stock analysis on the company to determine if it's a buy, hold, or sell. And the 5-minute stock analysis coming right now. All right, let's start the 5-minute stock analysis on Molson Coors Brewing Company. You can find New York Stock Exchange as TAP. Find the stock symbol to be interesting because since it's a brewing company, they have it tapped. It's pretty cool. But anyway, Molson Coors Beverage Company is a multinational brewing company formed in 2005 by the merger of Molson of Canada and Coors of the United States. It is the world's 7th largest brewer of volume. Some of the well-known brands are Miller Lite, Coors Light, Blue Moon, and Molson Canadian, and they have a whole list of other brands as well. All right, let's look at the fundamentals of the company. From 2009 to 2018, revenue grew at a great rate at 15.12%, and net income grew at a respectable rate of 5% from that same time period. The company has a credit rating of BBB minus, which is pretty low at the very end of investment grade. Operating income in that same time period, 2009 2018, came in at 14.64% compound annually, which is good. Earnings growth is good as well, decent, 3.23%. However, the last 5-year average revenue has a compound rate of 20% and net income at 14%, and earnings for the past 5 years grew at a 10.83%, which is great. So recent years has been growing much better rate versus their 10-year average. Last year they had an earnings reported at $5.04, and net margin came in at 10.37. Net margin actually has been compressing versus 2017, which was 12.85%. So net margin is decreasing. It's probably understandable in this competitive market, the brewing market. Return on equity at 8.35. Debt to cap is a good ratio at 36%. They have a great dividend yield at 4.52% and a decent payout ratio of 53%. However, they haven't been growing dividends for the past 3 years, but they did announce a whopping 39% increase in July of this year. They have a 5-year dividend average of 2.15%, which is very favorable compared to the current dividend yield, 4.52. So you could get it right now at basically double the yield. Future outlook, earnings are actually expected to come in lower than 2018 earnings, which was $5.04. So 2019 is $4.32, and 2020 to be lower at $4.01. CFRA is projecting a 1% growth in earnings for the next 3 years, which is not great. And running my dividend drill return model analysis came in at 8.5% total return. I don't like that. I like to see it above 9. It's close to it, but I like to see it 9 and greater. Currently, the PE of the company at 11.51 with a forward PE of 11.75. I like to see that in reverse. As far as current PE should be higher than the forward PE. That means earnings are projected to be higher. However, if we look at the fast graph, you can see here the black line is the monthly closing price, the blue line is the normal PE, and the orange the earnings PE of 15, rather 10. And basically this, I would like to see the company at much lower than the orange line, maybe have a PE of 8 or 9. That's where I would like to see it based on this graph. So let's see the fair price of the company. Currently, CFRA has a $26.14 fair price, Morningstar 66, Simply Wally 96, Fast Grab at 45, Yahoo at 55, and my dividend discount analysis at 25. And the reason why it's low is because they haven't really been growing dividends. Just the most recent increase of the 39%. So averaging out the 6 fair price, we get a fair price of 52.46. Currently, they're $50.48, so that means the company is undervalued by 4%. However, I think the company at current price is a hold. Like I said, I would like to see it at about 8 PE ratio or 9. if I were to consider it as a buy. I do like the high dividend yield. I love the most recent dividend growth increase of July, which was 39%. That's outstanding. But I don't see that going forward, in the next few years, because earnings are expected to be lower. And at current price, I find it to be fairly valued. Like I said, I would like to see it around 15 or 20% under my fair price, which will make it for me to consider it as a buy. I also don't like the fact that the company has not grown its dividend for the past 3 years. Hopefully, with the most recent announcement, they'll start growing it every year. So with that, I recommend it TAP as a hold. I like the yield, but the earnings are expected to be lower and the growth is not that great. So therefore, I recommend it as a hold. So if you have a company that you would like to see next, please leave a comment and let me know. And thank you for watching. If you find this video informative, please hit the like button and subscribe to my channel. Also, you can check out my portfolio in the description link. And don't forget to take a look at my website, physicalvoyage.com. Thank you and have a great day.